Hi everyone, welcome back to my channel. Today we are going to talk about leverage ratios, which is also called the solvency ratios under ratio analysis. Now here there are a few important ratios to be understood. Why it is called solvency ratios is because these ratios will tell how solvent a company is, whether or not it is soon going into liquidation, and how well equipped the company is to meet its debts, which is long term liabilities, to cover that whether the company is well equipped. So, to understand further, let's look into the detailed ratios. First is the debt ratio, which is total debt upon total assets. Next comes the debt equity ratio, which is again total debts upon total equity, which is the shareholders' equity. All right, which is the share capital, equity share capital plus preference share capital plus reserves and surplus. So when we talk of equity, it is equity share capital plus preference share capital plus reserves and surplus. Then comes the interest coverage ratio, which is EBIT, that is earnings before interest and tax, which is nothing but the operating profit of the business divided by the interest expense. This ratio tells how well covered the company is. Is the company generating enough operating profit to cover the interest expense of the company? The loan that the company has taken, there is an interest component on that loan, whether the company is generating enough operating profits to cover this interest expense. So that tells us the interest coverage ratio. Then comes a further detailed into the from the third step into the fourth step is debt service coverage ratio, which is also the short form is DSCR. This ratio is another extension of the interest coverage ratio, which tells us the total income divided by the debt service. Now, to understand this further, we should know what total income means. It refers to net profit after tax, plus we will add back the depreciation component because it is a non-cash expenditure, plus we will add back the interest component because we are going to look at the overall debt service, so we need to add back these two items to the net profit after tax to know the total income available. To cover this debt service, how much is the total income available with the company? That is the main motto of understanding this particular ratio. Now, after knowing the total income, we divide this by the debt service. What is debt service? The interest component plus the loan installment. So these two items together clubbed gives us the debt service amount and then the total income. So if we divide the total income by the debt service, we will get to know the debt service coverage ratio, which tells us how well equipped the company's net profits are to meet its long term debt service liabilities, which is the interest plus the loan installment on that particular funding. So, these are the main important leverage ratios or the solvency ratios, which is very important to understand a company's balance sheet and its solvency position. Please stick to my channel to look out for more such ratios. Thank you.